In this video, we're going to talk about buybacks and more specifically buybacks by financial services firm. The video comes in the wake of a recent announcement by a company, Indiabulls Housing Finance, to consider a share buyback plan on the board meeting. And it's intriguing and interesting because typically the way financial services firms work, it makes it a curious case on why would a company go for a buyback, right? So first, let's understand what's a buyback. There's a company and there are its shareholders who are there. These shareholders could have, so the company could have some cash balances on the asset side and reserves on the liability side that are there, and the company could choose to return some of this cash to the shareholders, right? Some of these shareholders could basically, so either the company could give dividend or some of these shareholders could then take part in a process called a buyback, where the company basically buys back its own shares by paying this cash out and then extinguishes those shares, so reserves also go out by that same amount, right? So that's the accounting entry in terms of what happens on the balance sheet. So typically that's how it works. Some people get the cash, the others basically remain in the company. Proportionate shareholding of everyone goes up. Those who remain in the company, those who have moved out, it's like a dividend to them. So it's more or less like a selective dividend to people who have taken part in the buyback, right? Now let's also understand how a bank works. A bank basically takes deposits, let's say $100 of deposits, and it's supposed to put its own capital of about $10. I'm using hypothetical numbers here to add up 110 for the bank, which then it can give out in terms of loans. And it has to have some sort of liquidity measures there in terms of CRR and SLR that it has to keep, right? So inherently there is a framework called the capital adequacy framework, the capital adequacy ratio that banks have, which mandates that a bank needs to have a minimum amount of capital to be able to grow, keep a certain amount of assets in the form of loans, right? Capital adequacy is defined in terms of a percentage of risk-weighted assets. Basically, the assets are weighted based on the respective risk they carry. So if you have a bigger capital, you can go and give too many loans. If your capital is dwindling, then you cannot give loans. If you don't have capital, then you cannot really give too many loans, because that ratio has to be maintained. So if for argument's sake, with 10 rupees of capital, you can argument's sake give 80 rupees of loans, then if the capital goes down to 6 rupees, you can only give 48 rupees of loans. Right, so that's the spectrum of how a bank would work or an NBFC would work, because these are kind of regulations drafted by the central bank in terms of how a banking sector would, or how you would safeguard the depositors in this entire context, right? So that's how it works. Now we have this curious case that there's this company, Indiabulls Housing Finance, which is saying they're going to do a buyback because they are sitting with too much cash, right? So the first question that would come to our mind is, why would any company do this, right? Capital in a banking setup is equal to growth. Most banking companies typically raise capital. They issue shares and raise capital because then they can use this capital to increase their assets and grow further. This company, on the other hand, is trying to reduce its capital, right? So the only reason they would be doing that is they're sitting on too much cash. That's one possibility. And they see probably too little growth opportunities, both of which are a little bit tricky kind of a situations that would play out. With a financial services firm, the other thing that becomes interesting is, why would lenders agree to this? Remember, lenders have the first right to the money that comes into the company. So technically, if you have cash and you're doing a buyback and lenders are in stress, I mean, you're not paying your lenders, or there is a possibility that you may not pay the lenders. A lot of the lenders may not even approve this easily, right? So would the lenders agree? And the third question that comes is, what about the liquidity crisis? We have a scenario where almost all housing finance companies or NBFCs in India at this point of time are reeling under the pressure of, where do you raise money from? Cost of funds is going higher. There is a trust crisis that is playing out. No one wants to give money to these guys. Mutual funds don't want to give money. Banks don't want to give money to these guys. And here there is a company who has cash that can be used to grow, but instead they are returning this money to shareholders in order to basically create sort of a trust with their stock price. So that doesn't add up in itself, right? So it's a curious case. That's about it from us in this particular video. What are your thoughts on it? Please leave them in the comments.